Okay, welcome to the tutorial on the Dragonfly options spread. Thank you for joining us. And we think the best way to learn about the Dragonfly and all the different character traits is to really compare it to the Iron Condor strategy. So with that said, let's go ahead and get started. You can see the dashboard there to Theta Trader on the screen. And then notice the black arrow. That's where the Dragonflies are notated and listed as a theta trade on any given day. They are a neutral strategy. This highlighted here in blue is ES, E-mini S&P 500. So this is where you could find the Dragonfly theta trades as well as the Condor trades. So drilling down, you could see Dragonflies here listed for this particular day, anywhere from 36 to 71 days till expiration. You'll notice the strike prices of the puts and calls that are being sold as part of the Dragonfly strategy. And let's take a look here, sort of an overhead view by looking at a chart. It's always good to look at a graph. I think it's more clearly explained that way. So in this case, this particular theta trade here, you can see, first of all, the Dragonfly has 6 options, 3 puts, and 3 calls. But they're always done in different quantities, and let me show you how that works. First of all, let's look at the ones that we are buying closer to the money. 32.70 calls, 28.10 puts, and you're buying 1 of each. Then you sell 4 33.10 calls and 27.70 puts, and then you buy 3 further out of the money calls and puts as protection against a dramatically large sudden move. So these are Dragonflies are covered strategies. It's a covered spread. These are not naked options that we're selling. You notice for every call that you sell, you're long an equal number. For every put you sell, you are long an equal number. Selling 4 puts and then buying 4. Same thing with the calls. You'll notice the difference between the strikes here. You see the 32.70 call that you bought is 40 points closer to the money compared to the 4 that you sold. You'll notice the same thing on the puts. You sold the 27.70 puts, 4 of those, but you bought 1 28.10 put, so 40 points closer to the money. And that acts sort of like an insurance policy, and it will create a totally different characteristic as the market price is moving perhaps closer to the upper or lower boundary at some point during the trade. Completely different compared to an iron condor. So here's what it looks like when you drill down and look at the details of a Dragonfly spread. You can see your put and your call risk there. Notice the maximum profit potential on a Dragonfly spread listed right there. Your total targeted, return on your cash, targeted return. And let's look at the quantity, always defaults to 1. So 1 Dragonfly spread always means you're selling a minimum of 4 calls and 4 puts, along with buying 4 calls and 4 puts. So you do it in increments of 4. So if you wanted to do 2 Dragonfly strategies, you would have 8 options that you're selling, 8 puts and 8 calls. If you wanted to do 3 Dragonflies, of course, you'd be doing then selling 12 calls and 12 puts and so on and so forth. You see the net price there of the strategy. And then if you wanted to add discretion to your order, you could. And now taking a look at this chart again, I want to show you the simulator. The trade simulator is something that can be reached in the Theta Trader or from the Theta Trader dashboard or really anywhere. Along the top menu under trading, you just click simulator. You'll notice the dates here that you can choose from. You can go back in time. So in this case, we went back to February 14 of 2019. pick the neutral strategy for the ES. So you see the dragonflies and the condors are then populated. And this is what it would look like on the subsequent screen. So you have 4 dragonflies to choose from. And what is that? 7 condors to choose from. All right, now let's go ahead and show you the simulator. Let's take a look at the simulator, and we're going to walk through 2 examples of a dragonfly compared to a condor. Okay, here's the dashboard for ThetaTrader. You may be familiar with that. And you'll notice the theta trades for today. Here's the neutral tab clicked already. You see the E-mini S&P 500 market there. You see the dragonflies and condors available to choose from. And then going up here, you go to the trade simulator. If you click that, you can then pull up any trades that you wish backwards in time. So I've already done that. And let's take a look here at some examples. This is an iron condor from February 14. Let's go ahead and play this out and see what happens. You notice the green RTI signal there. That means all systems go, nothing to do. And the trade is playing itself out. And then it turns blue. And blue means take profits. And ThetaTrader can automatically take profits and close out trades for you if there's too much risk. So it's a profit directive and a risk directive, and it can automatically do that for you. And I will show you how to make that happen in just a moment. But notice here on this condor trade, it took profits with 2 days remaining till expiration. Now it should be noted that we never suggest holding any of these trades till expiration. We always close them out one way or another for a win or a loss before expiration. And that is the goal when you're selling such a trade as a condor or a dragonfly or any credit spread, really. There's no need to hang on and try to basically squeeze all the last drops out of the lemon. The risk isn't worth the reward, in our opinion. Now let's look at a dragonfly. So here is a dragonfly. Here's the same day. So instead of placing a condor, imagine you had placed a dragonfly on that same day. So go ahead and let's watch this trade play out. You can see all is well. Everything is green. And look at this. It turns blue with 34 and 33 days still remaining on the trade. So this trade matured very quickly and allowed us to get a blue profit-taking signal, and there was still over a month of time in the trade. And why is that? Well, remember the dragonfly has a different structure, and you are long a call option that's closer to the money compared to the ones that you sold. You're also long a put option that's closer to the money compared to the ones that you sold. So these options that are closer to the money are going to hold their value much better and perhaps even gain in value at times if the market is moving near the boundary of the call or the put. So keep that in mind, that you can also automate this, and let me show you in just a moment, but let's look at another example here. Here's a condor from November 20. Let's play this one out, see what happens. Everything is green, no trouble. Turns yellow, that means a slightly elevated risk, and then it turns red. So on January 16, with 16 days left, the risk was too great according to the ThetaTrader algorithm. ThetaTrader said, get out, cover the risk, and take your money and go elsewhere. So that would be a losing position on that particular condor. Now let's look at the same exact date and what happens if we would have placed a dragonfly. So let's go ahead. And look at this. With 29 days remaining in the trade, the Dragonfly issues a profit-taking signal. You'll notice here the 33.30 calls that you sold on the Dragonfly are the same that you sold on the Condor. You're selling the same calls and puts, but in this case, you are long a 32.90 call, and that 32.90 call is 40 points closer to the money. And therefore, as the market's moving closer and closer toward your call positions, this long option is actually gaining in value at a faster rate, or at the very least not losing its value as quickly. The theta decay is slower. So that is why this position was able to become profitable. And you should also note that it even turned profitable beyond the maximum that you received when you sold the position. So you're actually getting paid to close out this position at this level. Now, if you were to continue and you just ignored that profit-taking signal, what would happen? Look at that. It turns red. So you would have taken a winning trade and turned it into a losing trade. I want to point out something too here. See the date, January 16, with 16 days left. That's the same day that the Condor gave a signal to get out and cover the risk and take a loss and move on. So really the Condor never matured enough to reach profitability. It just issued a loss-taking risk signal to get out on January 16. But if you were doing a Dragonfly, you would have been able to place orders and close out this position perhaps over a period of several days here once it turned blue and was mature enough to get out and take profits. And had you ignored that and just stayed in it, you would get the same risk RTI signal here on the same day as the Condor that we just saw. Now let me show you in ThetaTrader where you can set up the risk directive. You go to My Account and you go to the settings, and here it is here. You just check this box here to activate the risk manager, activate the profit directive, and then be sure to save your settings. And if you need any review on any aspects within ThetaTrader, in particular the risk thermal indicator, what those colors mean, simply go up to the help file here, click on glossary, scroll down, and you'll note all the different acronyms here are explained and all the different colors for the sold positions and the RTI. And then, of course, there's a strategy review, just definitions for various strategies. All right, well, very good. So that is going to wrap up the tutorial on the Dragonfly. If you have any comments or questions, we'd love to hear your feedback, and we look forward to hearing from you soon. Thank you.